So back in April, the Economic Programme Oversight Committee, EPOC, got together to check out how the country is doing with its fiscal and monetary performance. So what did they find out and what suggestions do they have? Joining us now is co-chair of EPOC, Keith Duncan. Welcome back to the show, Keith.
Thank you, Kalilah, and thank you for having me. And good night to your listeners and viewers. And Kalilah is actually the co-chair disappeared in 2019 when we moved away from the IMF program, when I was actually co-chair.
Okay.
Yes, as chairman.
Okay. All right, good. Thanks for that clarification. So that's the hat that you're wearing tonight, because you're no stranger to this show. You've been here in different capacities, but tonight you're here in the capacity as chairman of EPOC. First of all, for those who don't know what EPOC does, just give us a brief overview.
Okay. So EPOC was actually set up in 2013 on the IMF program, the Extended Fund Facility, through 2013 and 16, and it came together with the financial sector, coming together with civil society, with the support of Dr. Peter Phillips, to provide oversight over Jamaica's economic program. Elements of that economic program are your fiscal policies and your monetary policies. Fiscal is being in your budget, your revenues, your expenditures, and the monetary being your inflation, your exchange rate, your international reserves, and monetary policy in general. In terms of monitoring the monetary and the fiscal policies of the government of Jamaica, ensuring that you're hitting your having oversight over the quantitative targets and your policy commitments in terms of what are the policy commitments that are embedded in the economic program.
So you are the overseer of the government's economic program, and it was quite a novel thing when EPOC was implemented several years ago. So in the most recent meeting and overview, there are a few things that stood out. So lower than expected tax revenues, for one, and then of course the inflation rates, which we've been watching like a hawk, especially over the past few months. So how are these affecting Jamaica's economic stability and growth?
Right. Well, we know they're at the underlying factor that's driving policy globally right now is inflation, and inflation from COVID, when there was the supply chain disruptions, the disruption to the logistics, and basically, the shipping costs went up through the roof, and there was therefore supply chain disruptions, and inflation started to move upwards. That was also accommodated by loose monetary policy in that period, and then there were easy monetary policy to stimulate the economy and drive liquidity into the markets to help, as I said, drive economic activity, and then that continued. Everyone thought that inflation was going to be transitionary, and then Ukraine happened, and it no longer was transitionary, and it became inflation became almost embedded in the global economic kind of landscape because of commodity prices went up, oil prices went up, and further supply chain disruptions, and then so the globe, including Jamaica, has been fighting this inflation for a while. Inflation went outside of the range, or the BOJ target range of 4 to 6%, and BOJ had to tighten, and the BOJ had to tighten monetary policy. The GOJ gives the BOJ the target range for inflation, which is 4 to 6%. The BOJ in its inflation targeting is very much focused around using tight monetary policy, increasing interest rates from 50 basis points or half a percentage point to 7% over a 2 to 3 year period, and has held interest rates there steady and kept liquidity very tight in pulling back the liquidity out that it injected with COVID, and therefore keeping liquidity very tight. That has implications for your fiscal policy because your cost of debt increases for the government. It has implications because the policy is designed to slow down domestic demand, slow down economic activity, and raise interest rates to borrowers at your deposit-taking institutions and in the private capital markets. So therefore, the cost of money becomes expensive for borrowers, and therefore it reduces investments, because people are going to wait and see or hold on to investments because the cost of money has increased. Therefore, it slows the economy. And if you slow the economy, you slow tax revenues, and you basically slow because you have slowed economic activity and revenues. And it has a particular impact on the financial sector, because margins that the commercial banks and securities dealers and all that would be taking on net interest income are compressed. The markets are depressed, like, for example, the stock market and the fixed income markets, they'll be depressed, so there's not a lot of activity occurring. So it has an impact of slowing the entire economy, and this is because we're fighting inflation.
So is it time to revise that inflation target downward then? Because it is time for a review now.
Well, the review was done, and the Minister of Finance kept the target range at 4 to 6%, right? And however, inflation has come back within the target range for the first time since October of last year. It dipped into the 4 to 6% range in October of 23. It went back up with the increase in the public passenger vehicle fares, and it's back within the range of in March at 5.6%. The Bank of Jamaica projects that at their last monetary policy meeting, that inflation would continue to be out of the range until about September 2025. That was based on the assumption that the PPV fare increase that was due on April 1 of this year would have been implemented. The government of Jamaica pulled back on that fare increase because I believe they knew it would have an inflationary impact. That inflationary impact was modeled into BOJ's projections, which showed inflation outside of the 4 to 6% range up until September 2025. The BOJ will meet again in May, the Monetary Policy Committee. They will then run their models based on the fact that the PPV fares weren't increased. We would expect that inflation, their models would show inflation would moderate, and therefore maybe it would give the BOJ, because they're based on data, they're data driven, to say inflation is coming back within the range, it's on a downward trend, and therefore we can look to start easing monetary policy.
Because everybody's been complaining about inflation, and yes, it was outside of the range, it's back inside the range. But the question is, should we now reduce the range?
No, if you reduce the range, because the range is 4 to 6%, right? So inflation has to be within that range, right? So you're making it harder because they would like to see interest rate average out at about 5%, right? Now, if you reduce the range, then you're going to say it's going to be, BOJ is going to have to work that much harder with monetary policy, which means monetary policy tightening to get inflation lower than that 4 to 6%, right? So therefore, it is fine where it is, and it should move within the range of 4 to 6%. We're hoping faster than they anticipated for next year, because the government of Jamaica held off on the increase in transportation fares, right? So therefore, BOJ should be able to look in their May meeting, when the Monetary Policy Committee meets and they make a decision around interest rates, to send a signal to the market that we're either going to reduce rates, or we're going to hold, or we're seeing positive signs, or we're looking to reduce interest rates. I believe the central government, the central bank governor, Richard Biles, when he was in DC at the IDB conference, did indicate that he's looking at maybe reducing interest rates towards in a few months. We're hoping that that can happen faster, because we think that would drive confidence into equity markets. It would increase liquidity. The market is just very tight. It's almost like we're in a vice grip in terms of financial services, and the cost of money is expensive, and everybody's looking for a breather.
Mm-hmm. And then what about something that I raised earlier as well, the tax revenue collection? That was below target. Is that something to be concerned about? Because I think it's $25 billion. That's a lot of money.
Right. Well, that's, when you look at the tax revenue targets, right? So therefore, the budget for the year for tax revenues was to be 831 billion, right? Was the budget for the year, let me give you the accurate numbers, Kalilah, right? The budget for the year in terms of tax revenues were for 23-24 was $856.4 billion, right? What the actual outturn was 831 billion. So we're actually 24 billion, 2.9% behind. So we're marginally behind our tax revenue budget. It's not a huge underperformance. Up to February, we were ahead of target. And it is in the month of March that there was a fall off in tax revenues. And that was driven by corporate income taxes, because we did not get the budgeted, the windfall that you normally get in the month of March when everybody pays their income taxes in the month of March from the corporates. A lot of that was driven by the financial sector, because they themselves remitted lower taxes because they have been impacted by the tight monetary policy, the higher interest rates, and their compressed margins. So, but businesses on a whole are feeling the impact of tight monetary policy. So therefore, corporate income taxes were flat year over year. GCT was on target, PAYE was on target, but corporate income taxes, business taxes were behind target.
So break that down for me a little further. Is it that businesses just didn't pay their taxes on time, or they are due less taxes than they were last year?
Well, they're making less money. So financial services firms are making less money because they have, most of them, right? Therefore, they would remit less taxes, right? So financial services, some businesses that have to serve their debt to service, interest costs would be higher, and therefore they would their profits would be reduced. Businesses, therefore, once you are a business and you have debt, your margins are going to be squeezed because your cost of money is more expensive. Therefore, you make less profit. Investments that you had planned for the future, you probably are not going to take them on at these elevated interest rates, and therefore the growth that you would have anticipated in your business, you have kind of held off. Let's wait and see what happens. Let's see if interest rates come off. And therefore, corporate income taxes came in at $93 billion, which was the same as last year. That means corporate income taxes were flat year over year, right? But overall tax revenues grew by 10% year over year. It moving from tax revenues grew by 78.7 billion, 24 billion behind budget, but grew 10% year over year. But it was corporate income taxes, business taxes that remained flat.
So, all right. So that means that it's not that we're going to make it up in April. It's just not going to be paid because.
Well, the minister, I think the minister was clear that they need to do that. They need to investigate, because they said that some people filed but didn't pay, and that there was the impact of IFRS 17 on insurance companies, and all that had an impact, and then therefore there could be a timing issue. And he said what we would hear in the month of May, June, assess the numbers, see if there were any timing issues, and then we see where we come out. But what we know is that there was some weakness in corporate income taxes in the month of March.
Now, on the positive side, we talk about negative, we also have to talk about positive. We did hear good news concerning the net international reserves, the NIR. They hit record levels in March. What does this mean for the country?
Well, it means that we always have a buffer in case there is any kind of fallout in the economy. If there's a fallout in, for example, do you remember with COVID, we lost our tourism industry. And if you have the high levels of net international reserves, what you have is a buffer, right? And therefore it really helps you out in crisis periods, or as we look to keep our exchange rate stable. We have high levels of net international reserves, and remember, one of the policy imperatives of the BOJ is exchange rate stability. So you use the NIR, the net international reserves, that 5 billion, to defend the currency in times of extreme volatility. And therefore, that's why over the last 2 to 3 years, we have kept exchange rate very stable. That's like a new phenomenon for Jamaica. Everybody used to think that, boy, exchange rate is going to keep moving and moving and moving and moving. And the Bank of Jamaica has been quite successful because it has reserves that's able to defend the currency and keep it stable within a range, still under exchange rate stability.
So I want to ask you to kind of put on both hats now, as a banker and as chairman of EPOC, because we spoke about the financial sector and profits not being what was expected based on the budget and all of that, and you outlined some of the reasons for that. How does this impact the stability of the financial sector going into fiscal year 2020? What's this, 24, 25? No, we're already in it.
Yeah, well, Kalilah, the financial sector is very stable. It's well capitalized. There is enough liquidity. There doesn't seem to be any. And the Bank of Jamaica reports around this in terms of the financial stability, that the financial sector is quite stable. And what you will see fall out in the margins, you will see maybe, non-performing loans increase marginally because customers just cannot afford to service their debt, and therefore, they have to look to restructure otherwise. But if you look at all the key performance indicators for the financial sector, remain stable, less profitable outside of maybe one or two players, okay? But there's less profitability, less return on equity at this point in time within the financial sector because of just, if your stock in trade is money and the Bank of Jamaica is tight in liquidity and pull money out of the market, then there's less money for you to trade, right? So and the money becomes more expensive because you have to compete for it, and therefore the cost of the money increases, and that means your cost of funds increase. You can't pass on all of that cost of funds increase, where the Bank of Jamaica move interest rates from 0.5% or 50 basis points or 0.5% to 7%. You can't pass it on to your customer because you're going to put your customer under significant stress to be able to manage that kind of increase. So you would have not seen the banks passing on those levels of increases to the borrowers, its customers, because you put them in a very difficult position. So therefore, the bank would be accepting tighter margins and compressed spreads in doing business, and therefore profits reduce. Therefore, less taxes are remitted to the government of Jamaica.
How does all of this impact employment, especially in your sector?
Well, you hear that there is retrenchment across, in some financial institutions. NCB is driving for efficiency. They have said that very clearly, and everyone would have to look at their cost structure, right? And in looking at your cost structure, you look at your staff costs, you look at efficiency. You have less revenues, therefore you must tie your costs to your revenues, right? And your revenues have had the fallout in your revenues, therefore you must manage your cost structure, and therefore that would impact employment in that area. You know what I mean? So the financial sector would be like a dampener in the economy, but we see positives in the economy like tourism, like mining, and agriculture and other areas and manufacturing where we're seeing some positives, But the financial sector is a little, I would say, would be underperforming at this point in time.
Let me take some other comments and questions from our viewers. Gregory says, inflation not going anywhere anytime soon. Sad to say it going to be around for some time with what transpiring in the Middle East. Soon the price of petroleum is going to skyrocket, hence driving up inflation. Lala says, inflation not coming down anytime soon, sir. Do you not recognize what is happening in the world?
Of
then
course.
Max says food prices need to go down to level the playing field. And we have Ingrid echoing that, saying the food bill is ridiculous. I'm paying way more for less. So inflation being one of the top concerns
Yeah,
of our viewers, and anecdotally, I'd say most Jamaicans right now.
exactly. Well, I mean, if you do a cumulative, right, of inflation over the last since COVID, right, since 2020, inflation has been in the range of maybe 6 to at high of 11%. So if you say that's over 4 years, therefore, if you say that is somewhere between about 30% of your purchasing power has been eroded because of inflation. Year over year, you say inflation is 5.6, but it was 6 before the year before, and it was 7 the year before that, and it was whatever it was the year before that, right? Just using taking numbers out of the hat, but it has been in that range 68% every year. So your purchasing power is being eroded, and people, of course, will be feeling it in their pockets, right? On food, in food prices, in transportation costs, in all different, in the consumer price index, they would be feeling it in all buckets, and that is why it's important to get inflation under control. Of course, we have the geopolitical risk, like what we see happening in the Middle East, and and we see where oil prices and shipping prices are impacted. But what we're seeing right now is basically globally inflation is now coming down, and globally it's expected that inflation will average around 5% for this year. Globally, Jamaica is expected to be, as the Bank of Jamaica says, around 6.9%, and hopefully that will come in further. But everything is on a downward trend. Why would it be on a downward trend? It would be on a downward trend because the economies are slowing, because interest rates and monetary policy are tight. Interest rates are high, and they pull liquidity out of the system, like with those BOJ CDs. They pull liquidity out of the system, and they tighten up the money supply, and therefore the economy and areas of the economy will start to slow, and therefore that becomes disinflationary, and therefore we're hoping that inflation will get under control, not barring all the risks, the geopolitical risks, etc., but it's trending downwards globally and locally.
You know what's funny? 5 years ago, we had this conversation. I feel like it's the same conversation, but about devaluation, and now it's
Right.
over on the inflation side. So like
Exactly.
everywhere turn makajukyo, as the saying
Right.
goes. And
Yeah.
even though the macroeconomic numbers tend to look good over the
Yeah.
past few years,
Yes.
on a micro level, it's why we feel it in our pockets.
It's
When
tough.
might we expect some sort of reprieve? Like, when might the macro numbers trickle down to us so that we can
Well,
actually feel
let me, let me,
improvement?
more people are working, right? It's just that their purchasing power has been eroded. That's not by any fault of the policymakers. You know what I mean? They have been doing their best to fight inflation. That's the Bank of Jamaica, and import inflation is a lot of inflation is imported from when we have to buy goods and services from abroad. So we don't create that inflation here in the main. It's imported inflation. We can't do anything about it. Now, what we can do is adjust our wages and salaries, which is what people getting cost of living adjustments. But then businesses are under pressure, and they are trying to manage between their increased cost of money and their overall expense structure, their staff, their light bill, their this, their that, their other. So they're trying to manage their businesses while in this inflationary environment. That's why it's important to get inflation under control, and therefore you control the imported inflation by keeping the exchange rate stable, right? So what we would love to see is for keep the exchange rate stable, use your net international reserves, begin to bring down interest rates. You may see some confidence emerging in the equities market. You may see some people start to breathe a little bit because the cost of funds come down some more, and they start to say, okay, we're getting some signs that our economy could start to return, and therefore people start to see some more bright spots in the economy, because right now it's just being held tight.
I saw a report recently that Jamaica has one of the highest wages, salary levels in the Caribbean. We were third. So Barbados was number one, and Antigua and Barbuda, and then Jamaica.
I think, yeah.
So,
Trinidad is up there, I think. I think Trinidad, yeah. Mm-hmm.
Is it that things just rough everywhere right now?
Right. No, things are tight, right? In the US, you think the US is extremely challenged, and they're in an election year and they're putting on a good face, but they are very challenged. Small businesses, the financial services, they are facing challenging times also. They're holding it because, there's a lot of, the USA debt to GDP is over 110%. Jamaica's is at 72%, right? So the US is pumping a lot of money in while they still continue to fight inflation. They're pumping a lot of money into their military spend, etc., and driving their economy. However, and they're at the same time keeping interest rates fairly high, and their debt to GDP is increasing significantly. Jamaica is moving in the right direction with our debt to GDP. People don't feel it because of the inflation, but more people are working, right? And the economy is improving. The overall economy is improving. If we were in a non-inflationary environment, and today, people would feel a lot much better if inflation was back where it was prior to COVID, which was like 2-3%. People would feel a lot better. But we are in a global inflationary environment. Jamaica alone can't keep inflation. If inflation is over 3% in the US and globally it's over 5%, Jamaica is just one country within a global context, right? But as I'm making everything. I mean, if our economy was doing this well with high interest rates and tight monetary policy, can you imagine if we didn't have this inflationary environment?
Well, I hope that improves very soon. But what are your projections? I don't know if I should ask you for a projection or just a feeling. I haven't seen the most recent confidence surveys, but how confident are you in the Jamaican economy in the next year, 2 years, short term?
Yeah, well, Kalilah, given the global construct and where we are, and the Fed, the U.S. Federal Reserve holding interest rates at 5%, the whole world, all the central banks across the world are waiting on the U.S. Federal Reserve to reduce interest rates. You know what I mean? And if they don't reduce interest rates, then it's a major contributing factor to the decision-making process of the Bank of Jamaica and many central banks across the country, because they would like to ease monetary policy, but they know if they move, then it could introduce another risk which they don't want necessarily to take. You know what I mean? So therefore, the world is waiting on the U.S. Federal Reserve to move so we can start to ease monetary policy. At some point, if the U.S. Fed does not move, will Jamaica move before and be proactive? Because we're seeing the impact on our overall economy. The Jamaican economy.
Do you think we should, or should we just continue waiting, or you think we should be proactive?
I think, having built up the level of reserves that we have, right? So when we can look at our overall monetary policy mix, right? And that is, interest rates, that is open market operations, and through the Bank of Jamaica in pulling liquidity out of the market. So the Bank of Jamaica pulls liquidity out of the market through issuing those Bank of Jamaica CDs that we know about that are paying 10% monthly, right? They use that to pull liquidity out of the system. Now, what the Bank of Jamaica can do is start to ease monetary policy so that the economy can start to breathe, right? And right now we're seeing some contraction in some business areas. We're seeing it in construction, and we're seeing it in some areas, and we're seeing it in the financial sector. What we want now is them to look at the monetary policy mix to see if they can use their reserves, the net international reserves, maintain exchange rate stability, and there possibly some monetary policy ease and reduction in interest rates.
So don't wait on the U.S. Start easing now.
No, man, we're economically independent, Kalilah. Let us be proactive in the same way BOJ moved first before the Fed when interest rates were on their way up. Why can't we go before everybody else? Other countries have moved. Costa Rica has moved. Chile has moved. Other countries have moved. The Dominican Republic has moved and reduced interest rates. We are, so we're looking forward with bated breath to the Bank of Jamaica Monetary Policy Committee meeting in May, this month, May 20th, to hear what they have to say. So let's look out for that.
Next week, we'll definitely be looking out for it. Thank you so much, Keith. Appreciate it as usual.
Thank you, Kalilah. Good to see you.